Here's a question most people never think to ask. Your employer just handed you thousands of dollars in company stock. So why do so many people end up with almost nothing after taxes? If you've ever received RSUs, stock options, or been offered an ESPP and felt completely lost about what to do next, this video is going to change that. Today we're going deep on equity compensation. Not the basics you've already heard, but the advanced moves that actually protect and grow your wealth. Let's start by understanding what equity compensation actually is and why it matters more than your salary. When a company gives you equity, they're offering you ownership. That sounds great, but the way that ownership gets taxed, the timing of when you receive it, and the decisions you make in the days and weeks around those events can mean the difference between keeping 60 cents of every dollar or losing half of it to taxes before you even touch it. There are three main types of equity compensation you'll encounter. Restricted stock units, or RSUs, are the most common at public companies today. You're granted shares. They vest over time, usually 4 years with a 1-year cliff, and on the day they vest, they're taxed as ordinary income based on the fair market value that day. Stock options come in two flavors: incentive stock options, or ISOs, which have favorable tax treatment but complex rules, and non-qualified stock options, or NSOs, which are taxed as ordinary income when you exercise them. Finally, employee stock purchase plans, ESPPs, let you buy company stock at a discount, often 15%, which is basically instant guaranteed return before the stock moves at all. Now here's where most people make expensive mistakes. With RSUs, the most common error is holding all your shares simply because you work there and believe in the company. That's emotional decision-making, not financial strategy. Your equity is income that happened to arrive as stock. Would you take your entire paycheck and put it all into one company's stock? Probably not. So why do that with RSUs? The better framework is to treat vested RSUs as cash. Decide in advance what percentage you'll sell immediately and what percentage you'll hold for strategic reasons. Many financial planners recommend selling at least half on vest day and diversifying the proceeds. The tax timing piece is critical. When your RSUs vest, your company will withhold taxes, but most companies only withhold at the 22% federal rate, which is the supplemental wage rate. If you're in a higher bracket, which many equity recipients are, you will owe more at tax time than you expect. You need to either set aside the additional amount yourself or instruct your broker to sell enough shares to cover your full marginal tax rate. Not doing this is one of the most common and painful surprises people face in April. For stock options, the calculus gets more complex. With ISOs, if you exercise and hold for at least 2 years from the grant date and 1 year from exercise date, your gains are taxed at long-term capital gains rates, which are significantly lower than ordinary income rates. But exercising and holding also creates alternative minimum tax exposure, the AMT, which can hit you even if the stock later drops. The key decision is whether the potential tax savings justify the AMT risk and the concentration risk of holding a single stock. If you're sitting on in-the-money ISOs, run the numbers with a tax advisor before the year ends. ESPPs are often the most overlooked and underused benefit in corporate America. If your company offers a 15% discount and a look-back provision, meaning you buy at the lower of the stock price at the beginning or end of the offering period, you could be looking at returns of 20 to 40% even in a flat market. The strategy here is simple. Participate at the maximum contribution level allowed and sell your shares immediately upon purchase to lock in the discount. Yes, selling immediately means you pay ordinary income tax on the discount. But given the instant return and the elimination of single stock risk, immediate sale is usually the right move for most people. Now let's talk about the bigger picture. Building real wealth from equity compensation requires a system, not a series of reactive decisions. Start by creating what advisors call an equity calendar. Map out when each grant vests, when options expire, what your strike prices are, and what the tax implications are at each event. This calendar becomes your financial dashboard for equity. Review it quarterly so you're never caught off guard. The second piece is diversification timing. Concentrated stock positions are one of the biggest wealth destroyers for high-earning professionals. Even if you believe in your company, you're already exposed to it through your salary, your career trajectory, and your network. Your financial life should not also be a leveraged bet on a single stock. A disciplined rule, for example, never let one stock exceed 10% of your total investable assets, forces you to sell systematically regardless of how you feel about the company's prospects. The third piece is tax loss harvesting integration. In years when you're selling equity and generating significant income, look for offsetting losses elsewhere in your portfolio. Even selling positions that are down to harvest losses and immediately buying equivalent ETFs can offset thousands in taxable gains from equity events. This is a year-round strategy, not a December scramble. Finally, talk to a CPA or financial advisor who specifically understands equity compensation before major vest events, before you exercise options, and before year-end. The cost of that advice, a few hundred to a few $1,000s, is almost always far less than what you'd lose from a poorly timed decision. The bottom line: equity compensation is one of the most powerful wealth-building tools available to mid-career professionals, but only if you treat it with the intentionality it deserves. Build your equity calendar. Default to selling and diversifying unless you have a specific reason to hold. Protect yourself from tax surprises, and integrate your equity events into your broader financial plan. If you found this valuable, subscribe and hit the notification bell. We publish advanced money strategy every week. And drop a comment below. Are you sitting on RSUs or options you haven't made a plan for yet? Let's talk about it.